Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today we're going to be using a tool that might be familiar to some of you, but we're going to be using it to manage our covered call positions. It's known as the Strategy Roller tool, and it allows a trader who might have a bit of a habit for when they manage their covered call exits, might allow them to automate those exits and set those rolls to happen mechanically. I think this is going to be a great discussion. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see a lot of familiar names out there in YouTube as always. Hello there, David and Sharon, Ted, Will, Kevin, Joe, Ray, Eva, Paul, Kelly, everybody else. Thanks for joining us week after week. We always really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation. Be aware that you're invited to join us in this live discussion. This is a Monday webcast series, and we kick things off promptly at 2 Eastern time. We would love to have you here in our live stream audience. And as a nice little benefit for our live stream audience members, my very good friend Brent Moore is going to be hanging out with everyone who's here live. Hang out in the chats. Brent's going to be addressing any questions that I can't get to just during the flow of the presentation. Thanks for having my back there, Brent. And Brent and I would also like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite presenters there. It's the best place to connect with us in between these live streams. You can find Brent there at Brent Moore CS. You can find me on X at Cameron May CS. As a matter of fact, I spent some of my morning this morning just replying to some of the comments that had come in on X. So I'd love to see you there. But let's get into this discussion of using the Strategy Roller tool. And as we do, chat in and let me know, have you used this tool before? Just for paper, real money, doesn't matter which, but just I want to know the level of familiarity of my audience members with this Strategy Roller tool. All right, but some things to bear in mind as we get into this discussion. Risk is real, certainly applies to covered calls. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's talk about what we're going to be covering today. First thing that we're going to be doing is managing existing positions within our paper money portfolio, and that's actually going to set the stage for today's discussion. I want to spend the bulk of our time looking at those positions, setting those discussions within the framework of current market conditions, but then using the Strategy Roller to manage example exits for our covered call positions. We have a couple of positions that would be, well, we have one right now that I was thinking of running through this exercise. We have another that we're going to be adding that I might run through this exercise just to acquaint us with the tool. It's a tool that allows us to automate the rolling of positions that are associated with a covered call. Should be a good discussion. I'm looking forward to it. Now, the one thing that I won't be able to demonstrate today is that this tool is only truly fully live on the live platform. And we do our trading here in the paper money environment. So this tool, I can still illustrate it. We can just go all the way to the bottom and it's just not going to let me send that thing off. It doesn't matter. It's not going to affect the learning. But let's get right into this discussion. Let's go have a look at our existing positions. We have how many? 8 positions right now. Now, you'll notice several of these are just stock positions. So we'll talk about the history of these. We'll decide what to do with them from here. This webcast series is not called, trading stocks. It's called trading, it's covered calls and short puts. So we'll explain why these are here. Anyway, but let's start things off with Apple. This is our one position that's really been misbehaving pretty much from the outset of the trade. We're down on the current iteration of the trade, $2,200, but it's not quite that bad. It's still, we're underwater on this, but let me show you what's happening with Apple. This is a covered call position. Right now, we own 100 shares. You'll notice the trade price of $235 on the button. So it's a big round number, $235. Is it just coincidence? So we happen to get a trade execution right at $235. That might have been the case, but usually when I see big round numbers like that, that tells me either I had a long contract that was assigned or exercised, or a short contract that was assigned, and that was the case here. This was part of a wheel strategy where we sold a put to initiate, hopefully, a whole sequence or series of trades. So we wound up, we did sell a put that was ultimately assigned, leaving us with shares at 235. Those shares are only at $212 right now. So yeah, that's where we're taking our damage. But along the way, we've reduced some of that hit by selling options for income against that position. So as of this moment, we are in a 25th of July 215 call. That's below the price we paid. Yep, we're in an obligation right now to potentially have to sell shares for less than we originally paid for those. But let's go see the entire history of this. Let's look at Apple. So we started things off back here when we sold a 235 put for the 21st of March. That was assigned. So we collected an initial credit of $3. We retained that credit, but we also ultimately wound up buying the shares at 235, and those shares have trailed off since then. Obviously, we were doing much worse back in April. We've seen a pretty good recovery here. So going in the right direction. That's been cutting our losses. Also carrying a good lesson for traders that the markets are best at erasing the damage that the markets have done. Commonly, the question is, when a stock falls apart like this, what can I do as a trader to make up for it? Well, we might be able to do small things, place new trades that might carry new potential reward, but those new trades would also carry potential risk. Really, the way that a trader typically gets out of this sort of a hole is if the stock starts to cooperate better than it once was. In any case, we wound up buying the shares at 235, kept that premium of $3. That became a realized profit. We sold a 17th of April 235 call. That was right up at this strike as well. That we closed out for an 80-cent profit. We then sold a 16th of May, and this is interesting. We've kind of been rolling along, kind of lays the groundwork for this discussion today, rolling these positions, selling new calls along the way. We sold the 16th of May 230 call for a 149 profit. And you can see as these expire, we add new positions. We then sold a 20th of June, or sometimes we close them out. We don't always wait till expiration. But we sold the 20th of June 225 call. That was a 225 profit. Sold the 18th of June 220 call, 165 profit. And here we find ourselves. Stock has been rallying, but we're in for just a short period of time, expiring before earnings. This 25th of July 215 call, we've collected $1.33. I think that one is, yeah, look at that. It's right about what we sold it for, within pennies. So we're going to just let that one continue to work. But the bottom line here is we've collected over $9 of credit. I believe at this point it's actually over, is it $10? Yeah, $10.52, I think, net credits collected. That has lowered our break even from where we purchased the stock up at 235. Our break even is now at 224. So we're a little way below that 224 break even. If we were assigned on this 215 call, that would mean trade's over and we'd have a loss. That if we were to be assigned at 215, you notice that would be $9.48 below our break even. Sometimes trades just don't work out, but this stock plus trade management has done a pretty fair job of reducing that loss. So we'll see what happens from here. I'm going to let that one continue to work. Next up, we have Abbott, and that was our most complicated trade. To follow the history, the chronology of that trade, it's not all going to be that heavy lifting, but we do have some shares of ABT. Let's go to ABT. See what's going on with this. So with ABT, we bought the shares at 128.68. It was finding a recent support and actually just breaking up through a previous resistance. Bought those shares and sold at that time a 16th of May 135 call. That expired, and we retained a 132 realized profit on those contracts. Now we then sold it starting right here on this day out through the June 20th expiration. We sold it 20th of June, 135 call. Same strike, just a different expiration. That expired for $1.91 profit. So between those two, we're a little bit beyond, what is that, about $3.22 or something like that, $3.23 of now realized gain on our options. And with the stock now trading about $4 below what we paid for it, not quite, about $3.80. We're slightly underwater overall on this position. Now, we didn't sell a call after this one expired. You'll notice there's no dashed line representing a new call option up until this earnings. For some traders, they prefer to just not put a cap by selling a call. We know that introduces a maximum potential theoretical gain on our stock position for a period of time. And some traders don't like to do that over an earnings announcement. And that's what we chose to do here. Now, we might be paying the price for that decision a little bit, because in allowing for upside potential, we also didn't have a call that might have helped to reduce the downside risk exposure a bit. Now, selling calls is not a true hedge. It might just reduce the downside risk a little bit. But in any case, yeah, we took a setback on this earnings announcement. Now, some traders might look at this. Then I want you to put yourselves in the shoes of this hypothetical trader. Here we have a stock position which is bullish, that just gapped down on apparently a pretty disappointing earnings announcement. If we were the owner of those shares, we might have a decision to make here. Are we still bullish on this trade, or should we just get out of these shares? I think some might have just pulled the plug. They might have looked at a chart like this, if they're technically oriented traders, recognizing that there was an apparent support that had held for a couple of months right there, and we broke down through it pretty sharply. They might just pull the plug. Say, forget it, we're done. Now, others might look at this chart and they might say, yeah, that kind of hurt. But it's also interesting where we bottomed out over the last 72 hours of trading. That seems to be right at previous resistance levels. An old price ceiling might be acting as a new price floor. It was a price floor about 3 months ago. Maybe it will do that again. And I think what we're going to do today here is just make a decision. Let's exit if support breaks. Okay. That's going to be our plan for this position going forward. In the meantime, we're past this earnings announcement, and maybe the trader might look up to this previous resistance around that 130 level. I wonder what we could get by selling a covered call up there at that 130 level, maybe for that next August 15th expiration. Let's go out there to that monthly expiration. You'll see me go to those quite frequently in this webcast series, because the traditional third Friday monthly expirations typically have a little bit better liquidity than the weeklies. There's nothing inherently wrong with weekly options, but yeah, there just tends to be better liquidity with those monthlies. Let me look at the 130. That one's it's up there quite some distance. That's about a 22 delta, not a strong probability that this will ultimately be assigned. About a 78% probability this contract will just expire out of the money. Now, that's not the only use of delta, by the way. Delta can also tell us how much a contract might change in value as the stock price goes up or down $1. But with that so far up there, let's visualize that again, up there at 130. Here we are. And we only have until the 15th of August for that stock to travel all the way up there. It's a high probability trade if we're selling that contract, but the trade-off is there's not a huge premium there. I'm going to say our trader is still okay with that, but it looks like we might be able to get somewhere around $74, $75 for that trade right now. Let me click on that bid price. And let's see, so our natural is now 68 up to a mid of 73. Let's say that we're willing to settle for 70 cents. Let's click confirm and send. We're going to sell that 130 call for the 15th of August for a 70-cent limit. Now, we might feel like we're being generous in saying that we're willing to accept only 70 cents. There's still a chance this order might not fill. But let's see if we can get that 70 cents. This is going to say there's an infinite maximum loss. That would be true if we didn't own the stock. We do own the stock. So this is a covered position. There is a commission to be considered here. So that's going to chip into that potential credit. Let's send that off and see if we can get a quick fill there for our ABT position. So we're willing to accept a 70-cent credit. The mark is hovering there at 73 cents. I think this is likely to fill here pretty soon. But it did look like there was, even on those monthlies, a fairly wide spread that can make these a little bit slower to fill. There we go. Kelly says the strategy roller is on the Thinkorswim platform already. That's true. In paper money, though, it'll let you experiment with it. It just won't let you submit the order at the end of the trade. But in any case, so we're in that. What did we sell it for? I think I saw 72 cents up there. Let's go to our filled orders. Yeah, so we just sold that at 72 cents. Let me throw in a quick note up here. Here we are today, entered into a contract at the 130 level that's out through that expiration. So that's our new short contract. Okay, I'll fill in the rest of the details there after the webcast is over. But from here, our preference is for the stock to go up. But if the trader wants to retain ownership of those shares, maybe they have a preference for the stock to still be below 130 as we hit expiration. That's going to reduce the assignment risk. Assignment risk is still present. We still have a potential obligation to have to sell our shares at 130. But if the shares are below 130, that just makes it less likely. All right. 1 ounce of theory says delta direction with a 50-cent delta with every dollar move. The stock will result in a 50-cent move in the option. Well, yeah, just with one little modification of that statement, a 50-cent delta implies a 50-cent change in the value of the option if the stock goes up or down a dollar. We'd expect a 50-cent change, holding time and time and volatility constant, but not for every dollar, but the first dollar. That's the only modification I would make to that statement, but yeah, thank you. But there's our Abbott position. Let's have a quick peek at GILD. The rest of these, there's 4 of these that also are just long stock positions. I'll give you a little spoiler alert. We're not going to be doing anything with these because we are in the thick of earnings season, and most of these, and all of these, have earnings that are just a few days away. So we're just going to put ourselves in the shoes of that trader who prefers not to sell covered calls over an earnings announcement. There are pros and cons to doing that, as we just discussed with Abbott in the first place. But yeah, that's what we're going to do there. But Gilead, this was our long-term short put position. With GILD, our stock has been rallying, and we've sold a put into that rally. The preference for a put seller usually is for the contract to just expire worthless, and the higher the stock can go, the more it reduces the value of that put, and also, that might open the door for an earlier exit if the trader chooses to. But it also gives a higher probability of the contract just expiring worthless. So we're still up there at 109. We took this trade here when the stock was closer to about 111 to 114. So it's come down a little bit, but working its way toward expiration. And this trade is actually doing just fine as a result. Sold that for 310. It's only worth about 229. We may look at this. We have an order in, but the trader might look at exiting if maybe they could get out for half what they sold that put for. Not everybody has that as a rule, but we have that in place to exit this trade. So we'll let that one continue to work. So NEE, PM, Tesla, and Visa. Here's what's going on with those. NEE, we bought the stock, sold a call. This was a near miss. Let's go back to NEE. Let's open that up. We own a couple hundred shares. If you click on a value, you can, or on the quantity, we can see when that trade was executed. So this one, or initiated. This was April 17th. Price of 72.5. What does this tell me? This was an assigned contract, or it was either an exercised long call or an assigned short put. but we own the shares at 72 and a half, and we sold just last week. Is it last week? Yep. Sold an 18th of July, $76 call. So the stock was down here below this apparent resistance. We sold a call against that short stock, pardon me, against that stock position. I think we should change this. Let's edit this. Sold 2 calls, okay, because we have 200 shares here. Anyway, we sold those at 76, and those were set to expire on July 18th. So this was a short-term trade. The trader might think, oh, what could happen in a week? Well, look at where this stock rallied. We actually, as of Friday, at points during trading, this went up above $76. Now, when we're that close to expiration and a contract goes in the money, what happens to the early assignment risk? We got away with it here in paper money. May not have gotten away with this in a real account. In paper money, early assignment is not a thing. It doesn't happen. In a real account, when a contract goes in the money, that can elevate early assignment risk. But also, the closer we get to expiration, that can elevate early assignment risk. Now, even with that combination of factors, not every in-the-money contract is assigned early. As a matter of fact, most aren't, but it's still a possibility that a real trade could have been assigned. Might have wound up selling the shares at 76 bucks. Now, would that have been a disaster? Well, the shares would have been sold for more than they were originally purchased for, 72 and a half, but we'd be done. In this case, though, we faded to a close. Look at where we closed. Look up here in the upper left as I point at Friday's candle. 75.95, 5 cents out of the money. If I were to draw up the optimal Friday, that's just what a trader might be preferring, because the stock has gone up almost exactly as far as it can possibly go without just having automatic assignment when we hit expiration. So the contract just expired worthless. We pocketed that 55-cent profit per share, still own the shares, and now on Monday they continue to chug higher. So that's nice, but we're not going to be doing anything with this long stock position now, because we do have that earnings announcement right around the corner. Now, the rest of these weren't quite that close. We have Philip Morris. We were in a contract, bought the shares at 181.63. We sold the 187.5 call. That's expired, and we have a $1.40 profit there. The stock was pretty solidly out of the money at expiration. There's an earnings announcement right around the corner, so we're not going to be changing this position. We're not going to be selling a new call against that. Tesla, we'll have a look at that one. With Tesla, this one has been a great trade. Bought the shares at 233.07. Sold a 17th of April 280 call. That expired for a 249 profit. We waited a bit. Sold the 20th of June 365 call. We closed that for an 863 profit. Sold an 18th of July 345 call. That expired. You can see our stock was rallying up, but we are still a few dollars, actually more like $20. Looks like a few on a chart of Tesla. $20 out of the money. That expired worthless. And now the trader, if they're looking to retain the stock, they may want to be aware that there's an earnings announcement right around the corner, decide whether they're going to sell a covered call against that or not. I'm not going to. So we're going to leave Tesla alone. And finally, we have Visa and Walmart. Now, if you were to go back and look at last week's webcast, we didn't talk about Visa because Visa, we actually started things off here by selling a couple of short puts back in March and April. Our 21st of March put that we originally sold expired, and we just kept an 89-cent profit. And then we sold a 17th of April 330 put for 257. So between those two, we collected a little over $3 in premiums. That contract was assigned, though. So we wound up owning the shares at 330 as we dipped down here. And then they rallied. But I just kind of left those off to the side. They haven't been part of the discussion for the last couple of months. So let's bring those back into discussion. They were just sitting down here in our unallocated area of the portfolio. I just pushed those up here they were sitting down here with a quantity of 100. And I thought, why have I just left those down there? Let's bring them back into the discussion. So here we own 100 shares of Visa, purchased for $3.30, with a break even about $3 and change below that. There is an earnings announcement just around the corner there. So we'll look at this in coming weeks and maybe sell a covered call against that. Frank says, good morning, sir. Thanks for the class. Well, my pleasure, Frank. What's your criteria for selecting underlying stocks for this strategy? Is there a scan that one can use? A great question. Yeah. Whether we're talking about covered calls or short puts, both of those are bullish trades that actually have nearly identical reward and risk scenarios depending on the strikes and expirations selected. So the motivations for the trader of a covered call may be exactly the same as the trader of a short put. How might we choose a call? There could be a number of reasons. Okay, so a trader might first of all need different sector exposure. Maybe they're following some economic news and they think, ooh, like somebody asked earlier today, why are utilities and why are the utilities and technology sector doing so well right now? Well, it could be that AI is driving that technology sector and that the demand for energy to support that AI is driving the utilities sector, right? Well, maybe our trader thinks, oh, I need more, maybe I don't have exposure in one or the other of those sectors. And so that could be a motivating factor. They could look at the individual stocks and decide, well, which stocks seem to be leaders in this sector, or maybe they're value investors and they're looking for value metrics or growth metrics. There's so many different qualifiers. However, for options traders, there tend to be some metrics that enter into the equation for most traders. At least this is my observation. Number one is the price per share. Covered calls and short puts can tie up a significant amount of money in a trader's portfolio. So the price per share can play a larger and smaller role depending on the size of a trader's portfolio. So price is one thing. Liquidity typically plays a role as well. Illiquid stocks tend to have illiquid options and they can have pricing issues, making it difficult to get into and out of trades very smoothly. And the way that those pricing issues on illiquid options sort of reveals themselves, we see a drifting apart of the bid price and the ask price. And that can make it hard to get in initially, hard to get out eventually. It can also make it less profitable. When we have a wide bid-ask spread, that tends to lead to unfavorable fills for our traders. So price and liquidity can be considerations, but then also maybe just what's happening on the chart. So in my discussions, we'll typically look at the chart, see what's happening there, and look for maybe some traditional indications of bullishness. Right? Kelly says cost is important. Yeah, it certainly can be, right? Okay, market capitalization, Kelly. Yeah, could we go all day talking about different potential growth or value metrics or whatever else? Maybe the trader just likes to go in and they prefer to read the summary of the company's business operations on the fundamentals page and see if it suits their preferred approach to the markets. Could be a number of ways, a number of things. But our Visa, we're not going to do anything with that. And Walmart is just last week's trade. Last week, bought 100 shares, sold the 15th of August 25 call against that. So the preference here being for the stock to go up, but to stay below 100. And it's going up. But is it going? Hold on a second. Let's go. I shouldn't go on memory sometimes. Yeah, here we are. So we're rallying off these lows, and we'll just leave that to work. Now, I should clarify, we didn't actually buy our shares of Walmart last week, as you can see right there on your screen. This one actually started life off as a short put, sold a 21st of February put for $1.62. That's what that says. It's a little bit hard to read in that cluster of candles. And that contract was ultimately assigned right there. Look at that. Oh, we're not going to get assigned. Yes, we are. Got assigned. And then this one's just sort of been moving around. This is our first call that we've sold against this position while just kind of leaving it sort of mothballed down in the unallocated section. So we'll leave that one alone. Preference here is for the stock to go up, but to stay below 100 before expiration or as we approach expiration. So all of that's quite a bit, but I wanted to talk about managing now our covered call positions and explicitly, let's actually, let's, this is actually going to show you, this is going to be a good lesson here. We just sold a call against Abbott. And you'll notice over here, it says it's a split position. We have 100 shares here, and down below it says, oh, there's Abbott as well. And if we click on that, we can see there's our call. It's down in the unallocated. Now, this doesn't mean that it's an uncovered position. If we own the stock and we sold a call in the same account, this is just not grouped maybe the way that a trader might prefer. So let's right click here, move to group, and let's pop this up to our covered calls. There we go. Now we can see our Abbott position no longer says split position, and we can see the entire trade right there. But I wanted to talk about managing our Abbott position and our Walmart using the strategy roller tool. So that's right up here. Now, earlier in the webcast, I asked if some of you have used this strategy roller, and I see Josh said, nope. Kevin says, no, sir. Paul, no. Ted, no. Kelly says, I haven't. Will says no. And David says no. So it seems, I don't think I saw any yeses. Mo says, is there a way to create a covered calls watch list? So yes, there is. Mo, I think, are you talking about covered calls for intended, or a watch list for intended covered call positions for later, maybe things that you're not trading right now? Or are we talking about just having something monitored like we have right here, which is a group that I created? I might need to maybe just add that to the plan for a future webcast series rather than spending some time to go show how to do that right now. But yes, yeah, you can build a watch list. You can build even a search and just save that to look for covered call candidates. But in any case, let's get acquainted with this strategy roller tool. Now, I want to show you, this is intended for the management of covered calls. And for some traders, traders tend to be kind of creatures of habit. And I suspect that with the 167 people watching out there, there are going to be some of you who operate in just this way, where maybe we have a strategy like a covered call, and our trader just knows themselves, and they know in that final week before expiration, maybe in an effort to avoid assignment if possible, they may choose to roll their contracts, whether they're in the money or out of the money, just rolling in that final week. And maybe as they roll, maybe they have a specific preference for which strike price they choose. Maybe they typically go a few strike prices out of the money. Maybe they use Delta as a guide. But they just have these habits or these routines. Well, the strategy roller tool allows us to just automate those habits or routines. So let's go get acquainted with it. And as we go to the strategy roller, it will even tell us which of our positions are eligible for use in this tool. And you'll notice right up here, it says, there are no existing rolling strategies, but these are our eligible positions to add these rolling strategies. So Apple, I'm going to leave alone, but I want to use Abbott and Walmart as an example. How about we just go to Abbott? We just created this covered call, sold that 130 call. And to check says, is it a robo roller? Well, you might think of it that way. Yeah. I want to show you that there are a couple of ways to start this process. So we can either just come to strategy roller, go to the eligible positions, click on the little arrow to reveal the stock and the call position, and then just do a normal left click on the call position. So it's just click, and there's our strategy roller. I know that, that looks like quite the tool. Look down below, it looks complicated. It's, I think, pretty straightforward as we get into that. That's one way to do it. Now, another way to kick things off here is if we happen to be on our monitor page. Let's say we're here on our activity and positions, and we go to Abbott. We could just right click on our call and create a rolling strategy from there. You see that in the pop-up menu? That takes us right back to that screen. All right. So regardless of which way we launch this screen, let's walk through the automation of our rolling on this Abbott position. So the first thing it does is that it shows us our existing position. We own the stock and we're short a call. Down below that, we can tell, all right, if we're going to roll, how many contracts are we going to roll? Now, you might think, well, it's one contract, right? Well, not always. Trader, sometimes they'll have 200 or 300 or 400 shares, and maybe they only want to roll, let's say they have 400 shares, they only want to roll 2 contracts. They can do that. In this case, we're just going to do -1 for selling 1 new contract. Next thing we can decide is which strike price will we be rolling to? All right. So our strike can either be chosen as just being a certain number of strikes in or out of the money. So if we go up the chain, that tells the system, hey, go to the 3rd strike out of the money or the 2nd strike out of the money. If we were to go to the trade tab here and we brought up ABT, let's see our current position. Let's see our current position on ABT. That's a full 1, 2, what's our at the money? It's 125. So 1, 2, 3, 4, 5 strikes out of the money. That's interesting. So we could choose, an equivalent number of strikes out of the money. You can either use the plus or the minus, or just type that in there. That's one way to choose our strike. Or there are a good number of traders that just have a preferred delta that they typically sell. So maybe that's a 30-cent delta. When we're selling those lower deltas, that's where we're selling for a lower premium, but pushing that thing further out of the money. If I click on that, it gives me a slide bar where we can choose our delta by sliding it, or I could have just typed it into this box here. Well, let's say that our trader, maybe they do prefer to go out of the money. Some traders, they might actually go in the money. That might be at a time when they really think the stock is likely to rally and they're trying to get a bigger premium, or maybe they just don't mind selling the stock. But in this case, let's push this out to 30. Notice it's an either or, because trying to select, well, I want a certain number of strikes out of the money and an explicit delta, those two coming together and working perfectly with one another, probably not very likely. Now, the next thing is to choose which expiration. So we've selected which strike, number of contracts to roll, which expiration. Well, we can roll out a week, or we can roll out a month, or we can roll out multiple months. We typically, in this webcast series, go out typically about a month. So I'm going to tell this to roll out a month. Then I get this pop-up. Don't worry about this. The number of trading days from expiration has to be between 1 and... Anyway, don't worry about that. It's just talking about this next thing that we're going to fill out. So this is telling the system, it's basically the contract that we want to roll into. Next is, when do we want this to happen? So there are a couple of steps here as we look to choosing when we want this to happen. Let's say that our trader typically accomplishes their roll sometime in that final week before expiration. So we could say, I want this to start looking to roll within let's say, the 5 days before expiration. It is just to start. The system will start on whatever designated day, and it's going to try to get a fill according to what we tell it to look for. But ultimately, it's going to change this at the end of the week to just a market order. If it hasn't filled, if the system's not been able to fill this roll before expiration, it's going to switch this to a market to try to get it done and not get this right at expiration. All right, so we're going to begin this one 5 days before expiration. That's going to be our roll window. And we can now tell it, well, what price do we want? Do we want to be at the mid? Do we want to go all the way to the natural? Or do we want to be somewhere in between? So one thing I want to point out with this is that whatever we put here, let me put in like 75% between the mid and the natural. This does not automatically go in as well. The order goes in, 75% closer. Let's say it's closer to the natural than to the mid. Actually, the system will start at the mid and then work its way upward. Just like if a trader is trying to get the best fill price, then like, okay, it's not filling. Let me move that a little bit and try again and try again and try again. That's what the system will do. It'll automatically start at the mid, but it will not go all the way to the natural if you've said, let's say 75% of the way to the natural is the highest price I want to try to get. All right. So this is when it starts. This is the order execution instructions. We can tell when to activate this trade. Now, in my experience, when you look down here, it gives us a summary of our trade. And for me, even though I'm Mountain Time, it says Central Time. I believe that's the default. That's one thing you may want to check. Just as you're running through this in your own paper money, you can glance down there and just make sure it says Central Time. That gets you sort of oriented with what the execution time frame is. So we can activate this, let's say in the morning, and then maybe cancel it in the afternoon if it's not filling. Now, ultimately, down here at the bottom, it'll say move to market. And then there's a time of day selected. So this is the final day before expiration. We're saying, hey, at this time on the final day, just put in the market order and get me rolled, because if it doesn't, and we've gotten to expiration, if that contract is in the money, that will be assigned if we don't close it out and roll it out. There we go. So now finally, if we have it all outlined the way that we prefer, we can look down here and it gives us a summary. I think in very clear, clean language. So this strategy will roll your ABT 15th of August 130 call, and it'll tell us it's selected an expiration that's closest to 1 month out. So that would be the 15th of September call, nearest to the 30 delta, starting 5 days from expiration. A limit calendar/diagonal order will be placed between these minutes, Central Time, priced at the mid price of the trade on the first day of the strategy, and moving incrementally towards 75% between the mid price and the natural on the final day of trading. So 5 days before expiration, it's going to start at the mid, trying to get a fill according to the strike price and expiration that we've selected. And it's going to keep trying throughout the week if it can't get a fill. But on the final day, if that rolling order is not filled by, in this case, 11 o'clock Central, on that final day, it's just going to be replaced by a market order to roll. There we go. And then we can click confirm and send. Now we can get notifications here. In this paper money account, I don't have my email address or a text number. So if we want notifications about this, we could set that up. But just know we could set up those notifications. But the final step here is, you'll notice where it says confirm and activate. It's inert. We can't do that in paper money. In a real account, we can set this rolling strategy up. So Nino says, isn't it better to let it expire as long as it's out of the money? Better. Well, there's risk. Even if it's out of the money, it could go in the money and be assigned. Even an out of the money contract could be assigned. The trader just needs to keep an eye on things and make that decision. But that's our strategy roller tool. Now, I was going to walk us through the Walmart example for repetition. We don't have time to do that today, but I think this is interesting. It might be a good time to go experiment with this in your own paper money with a covered call. And some of you have asked about other strategies. This is explicitly for covered calls, for rolling those trade setups. Okay, so I'm just going to cancel this and call it a day. We've accomplished what I set out to do today. I wanted to look at our existing positions. I wanted to talk through using the strategy roller. One thing that I didn't give real justice to is what's going on with the S&P 500. That's okay. S&P's trading at all-time highs. I don't think I have any huge revelations there for you. But in any case, we're going to come back again next week and talk about covered calls and selling short puts for income. I hope you enjoyed this discussion. I have other webcasts every day of the week between now and then, so you're invited to join me at those. Now, a couple of things that I want to make you aware of before you go. First of all, make sure that you're subscribed to our Trader Talks channel. You can go down the lower right-hand corner and click on the subscribe button right now. It only takes a second, doesn't cost anything. But our channel is where we house our previous webcasts. You can find those under the playlist right here. Of course, you can also join the live streams right there. Another thing that I would suggest for you is that you follow Brent and me on X. You can find Brent on X at Brent Morris CS. You can find me on X at Cameron May CS. So, for example, I was just here on X replying to a post just a second ago, just before the webcast started, where I asked, do you think my stocks are a little bit bubbly right now, or do you think we're likely to go higher? Yes or no? People are giving me that feedback there. So it's a great place to connect with your favorite presenters in between these live streams. There's my handle right there, at Cameron May CS. All right, thank you, Brent, for helping out in chats. Everybody, I will see you next week. I'll also look for you in my other webcasts through the rest of this week. Thank you to everybody that's already clicked the thumbs up. That's always appreciated. That's just like a pat on the back to the presenter for their hard work, and it gives our webcasts a boost in the YouTube algorithm. So if you've watched one of our webcasts and you enjoyed it, make sure you click that like button. Again, doesn't cost anything, only takes a second to do it, and it's always appreciated and valuable to your presenter. Right? All right, go enjoy the rest of the webcast. I'll look for you on X. I'll also look for you in a future webcast. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.